Time for another market review where we're going to go over what's happening in the market, whether another crash is coming or at least another leg lower, if the bottom is in after that big move that we just saw, and everything else. We do this all the time. And as always, we got Alex from Macro Ops to help us out. But first, check out that explosive stocks checklist. It's still a good time to make some plays. There's a link down below in the description and comments. So first, let's start with a more general overview, and then we'll dive into the numbers and see where the market is heading. So when you think about macro, like global macro, which is what we do at our research firm Macro Ops, hence the name. All macro is really an aggregate of what happens at the micro level. So a bunch of small transactions make the big trends. And right now what we're seeing is that it's the micro where we might see the cascading shocks from what's happening right now. At the quarantines and the global economic shutdown. So the first thing you got to realize is that the US economy is 80% service-based. That means that much of our economy is dependent on in-person shopping, gatherings, and face-to-face meetings, everything that we're not allowed to do right now. And small businesses contribute roughly 45% to our GDP, and they make up 88% of total businesses and employ half of the US labor force. They're an anchor to the US economy. And right now, US corporate debt as a percentage of GDP is the highest that it's ever been. See, that's that yellow line right here. It's hitting a new high. It's been rising since even before the 70s. Now, going back to small businesses, the average small business has less than 27 days of cash. And that's a cash buffer, so it's the number of days that you can keep paying out your expenses even if there is no new income coming in. But in this 27-day average, there's a very wide range. You'll see right here that only 25% of businesses have over 62 days of cash and 25 have less than 13. So healthcare services have roughly 32 days and restaurants just 16, which is why this whole thing is scary for restaurants because they don't have the money to keep going. They have to be doing business. And this 27-day average, when I saw it, it was kind of shocking to me because right before this in my own small business, I was telling the guys like, you know what? We need to start building up cash because who knows what's going to happen. And this is before the whole virus thing hit. So fortunately, we're more to the right side of this curve, but I naively assumed that all businesses had a good cash buffer, at least small businesses, maybe not restaurants because that's such a tough game, but other businesses like healthcare services, I would think they would have a few months minimum. Looks like they only have 32. My personal goal is to go for 3 months, and I got some buddies who even do 6 months. That's ultra conservative. And of course, these things depend on what type of business you're in. And in my opinion, if you're a business owner, you should be saving some cash just in case for the rough times so you could keep paying your employees. But a lot of good business owners, I personally know, had to lay off everybody. And I do get it from the business perspective because if you're competing and you're holding all this cash, then that's not productive investment. But at the same time, like a value investor loves a business like that because they know they're going to weather through storms like this that only come once every 10 years maybe. And this particular storm is unheard of. So I really don't know what the right answer is for how much cash a business should keep. If you guys got an idea, put it down in the comments. Like I said, my goal is 3 months for my employees, but I know that's not possible for everyone. So what do you do? I don't know, comment down below. So the study, which was done by JP Morgan, concluded that many small businesses may not have enough cash to continue operations in the face of a month-long loss of cash inflows due to, this negative shock from quarantine and everything. So if you put everything together, we got an economy that is largely dependent on social in-person interaction. And it's the most leveraged that it's ever been, ever in history. And this is what I didn't talk about, which Alex gets into right here. See, the average small business, which is the backbone of the economy, not only carries a lot of debt, but also has less than a single month in cash reserves. So that becomes actually a huge issue, is that if your business has debt, you got to keep making those payments month after month, regardless of what cash is coming in. So in my business's case, we don't have debt, at least nothing significant. And a lot of the smart guys I talked to in their small businesses, again, they didn't have debt either, but they still had to lay off people. So imagine if you got your business shut down for a month and you got a bunch of debt. You're screwed. So maybe I answered my own question just now. Those employees are going to get laid off because you got to service your debt. And once again, is debt necessarily bad? No. Do you have to do it to stay competitive? Maybe. But it's a double-edged sword when we hit a situation like right now. So they got all this debt and a single month of cash reserves, and then we got quarantined for possibly the next 18 months, as I talked about in the last video. Bad combination. And on an even more micro level, again from a report from JP Morgan, the typical US household, who is also very levered up, holds less than $4,000 in liquid assets. So there's no cash, just $4,000. And here, just like the small businesses, there's a wide dispersion in the data. So yeah, 4,000 is the average, but nearly 30% of US adults have absolutely zero savings, and only 1 in 4 have a rainy day fund, fun, but not enough to cover 3 months of living expenses. So both businesses and individual people are running out of money. So really, if you look at economics, it's just a collection of interlocking balance sheets. My personal balance sheet affects the local business's balance sheet because what I spend is their income. That's what makes an economy. But the more levered all these balance sheets are, the more dependent on cash flows the system is, which is exactly what we were talking about with all the debt. So that's why it's so important that governments act aggressively and quickly, because it won't take long for this feedback loop with all this debt to have disastrous effects. They're going to ripple throughout the whole system and ruin everything. But even if they pull it off, even if they act like Congress just passed that bill, right? Many trillions, the system is still too large and too complex. And whatever they do is going to have unintended negative consequences. It's a tough job to try and manage the economy. That's why they screw up so much. And our team is going to be doing more research about this in the coming weeks, so make sure you subscribe for those videos. And one area in particular that we'll be looking at is China, because if you've seen our previous China videos and research, you know it's a house of cards. And the main card holding it up is the property market. With all those ghost cities and all the debt that they've built up and pumped into the economy. Well, now there's increasing signs that that property market is beginning to falter because of what's going on globally. So the government has exhausted its ability to pile on more debt, and the central bank is cornered. And if something like that happens in China, like a collapse of the property market, that's going to have huge ripple effects across the world. We've explained that in previous videos, but we're going to dive back into that thesis, so subscribe. But okay, now let's take a look at the actual markets, what's going on. So our base case is that we're about to, or we're already in, a severe recession. The market, as we can all see, is already working to price this in. Everybody knows the economic shock is going to be huge. Like, I think jobless reports come out Thursday. Everyone knows that's going to be horrible. So yeah, we're going to see unemployment spikes and indicators of economic activity fall through the floor. But this stuff is already priced in because the market understands that it's going to be bad. But what matters now and what will affect the stock prices, because this previous thing won't affect it because, as I said, it's already priced in. The market is forward looking and it's all about expectations. So what matters now is the expectation around the duration of the virus and our shutdown, and the expectation around whether our fiscal and monetary responses will work. And Alex expects these expectations to oscillate wildly over the coming weeks and months as new data comes in, because no one knows anything right now, and that's why we're getting ridiculous moves in the market, both up and down. Like a 10% up move in the market in a single day isn't exactly bullish, because that much volatility still means there's a ton of uncertainty. A nice steady 1% move might have been okay, but yeah, we're still in rough territory. So no one can predict where this market is going, but what we do know is that we are in a bear market. So this little up move that we're having right now, this is not the end, nor is it the bottom. Bear markets last on average 18 months, and they usually put in a double bottom or a complex double bottom that's formed over a long period of time. There's no V recovery here for a bear market. And as much as this market is sold off, it's still not pricing in the highest probability scenario of this virus and the economic shock that's coming from it. So because so much is unknown, the market still isn't pricing the worst case scenario. So Mark Minervini had a good tweet, he's a market wizard. Everyone's trying to nail the bottom of this once in a lifetime buying opportunity. First of all, it's not a once in a lifetime opportunity. Second, picking the bottom isn't the opportunity. The bull market that follows is that opportunity, and there's plenty of time for that. So don't try and be a bottom picker, don't be a hero. Instead, keep analyzing, and what we're looking at right now is how we close in March. Because remember, we use monthly candles to tell us the long-term trend. So the monthly March candle is close to forming another outsized bear bar. See, look at this thing, it's enormous. So if we end up closing at lows by the end of the month, it would put the 2000 level in the S&P and then the 2016 lows in play. So that's a 40 to 50% total sell-off from February highs. But if you take a look here, we're seeing this rebound, right? So the bulls might be fighting for prices to come back a little bit before the end of the month. So if we can keep going and close above the 2350 level, which right now we are currently above it, then this terrible candle will look a little different. It's going to have a long tail right here. And that reversal, and if we can close by the end of the month with that reversal, that raises the odds that we see a couple of weeks to months of up to sideways action in the US indices. Not saying that the bear market is over, but we might get a reprieve. So if you look at the 60-minute chart of the S&P, you can see that we've been in a month-long selling climax. It's formed a sharp descending triangle that we have broken above finally. See, these setups usually lead to big retracements higher, which is again what we're seeing right now. And if we go back to our normal analysis, technical, sentiment, positioning, well, from a sentiment perspective, everyone's extremely bearish now. This is a good buy signal. It's extreme fear. And remember, it's a contraindicator. So extreme fear is good for the market as far as prices going higher. Extreme bullishness is the opposite. That's bad. And if you look at the flow of money, we hit a bunch of extremes and records in the last week. So we hit a record outflow, $55 billion out of investment grade debt. We got a record out of emerging market debt, record outflow out of tips, record outflow out of municipal bonds, 5th largest outflow from gold ever, and just a bunch of outflow, which is again a sign of things exhausting itself. And if you look at market breadth, we're almost at a record of oversold levels. This is the percent of stocks above their 20-day moving average. It's like almost hitting 0. It is so low. This is almost the lowest it's ever been. Percent of stocks above their 50-day moving average, same, extremely low. Same with 200. We're getting real low down here in this green area. And remember, by the time you hit this green area, it signals that things are oversold and might turn around. But as you can see in these charts, it could hit the green level and keep going lower. So this isn't the only thing you can use because it'll give you false signals. And you can see right here the advanced decline line, this weak thrust indicator. It's hitting its first buy signal in 45 days. It's hitting this green line again. So that is bullish. Credit markets are also confirming the bullish action. You can see that the investment grade index is on track for its first multi-day rally in 5+ weeks. Now, if we look at this potential bear market rally that we're talking about, there's 2 catalysts to drive it. First is the likelihood of the US Senate passing that major fiscal stimulus bill, which as of this recording they did. And then Italy is finally seeing a consecutive decline in new daily cases. And it's funny, even though they passed the fiscal stimulus today, the market didn't react too much. But hey, staying steady is much better than dropping 5, 7, 10%, especially after we had this huge rebound yesterday. So maybe it's a good signal. But anyway, new daily cases in Italy are finally falling. It's a good sign. But you got to be careful working in a bear market. So based on all our analysis, the odds strongly suggest that we're in the early innings of a cyclical bear market, which will be accompanied by a recession starting within the next quarter. Now, bear markets last an average of 18 months, and a second major low, like we talked about, that double bottom, complex double bottom, is usually put in 12 months after the first major low. So we might, go up and sideways for the next year and then go back and test this low right here. Probably break it. That's what you see with the double bottom. So the most explosive short-term bull rallies, like what we might be seeing right now, they occur in bear markets because all the people that are trying to short things are forced to cover, as all the bulls who have been waiting think the bottom is finally in. So momentum leads to more momentum, and sideways chop would lead to more sideways chop, which is, remember what we said, we can go up a little bit and probably go sideways. And bear markets tend to spend more time trading sideways to up than they do going down, because obviously the way markets work, sell-offs happen much faster than going higher or going in a range. It's the escalator up, elevator down thing. Now these are all just odds and probabilities, like we can't know for sure. And the whole thing we're talking about, closing above 350 for the end of the month, that could easily fail. And then we got to update our analysis because we got some time. March isn't over. The market right now has extreme tape bomb and overnight gap risk because of how unique this situation is that we're going through. There's no good historical parallels for this. This time, if you say this time is different, you might actually be right. Everybody is flying blind. So due to that and the fact that volatility is so high right now, it's important to keep positions small and maintain plenty of dry powder. So this was released on this day right here, the 24th. And what Alex was saying is watch the close, because if we close near the highs, it raises the odds that we'll see further follow through, which is kind of what we're seeing today. But we'll probably need to see at least a few consecutive updates for the bulls to aggressively step back in and drive this rally significantly higher. So that's what I'm hoping for. And I say hope, it doesn't actually matter. I don't know what's going to happen, but it would be nice for my system, which I talked about all last week, the all-stars. And the people that are in it right now, we've seen already a few alerts go off for the active version. We're getting back into the market. And those current plays are doing pretty well because the market, it turned around and it's holding up so far. Now, the other model that I personally use more, the monthly model, because it's less activity, there's a rotation happening on April 1st. That's next Wednesday. So right now I'm almost all in cash, but on April 1st, I'll be deploying back into the market. So obviously if there's a rally or at least sideways action, that's going to be better for me, because even with sideways action, if you're invested in the best, highest momentum stocks, they should still be trending higher. And if it keeps going for a year, then hey, great, I can make some money. But who knows? I don't know. Nobody knows. The only thing I do know is that I got my risk control in place. So if this is a false rally and I get in on April 1st and all of a sudden the market tanks and all my stops are hit, it's going to suck, but I'm also going to survive. That's the way you got to play it when markets are crazy. Well, that's the way you play it even when markets aren't crazy. But we'll see what happens. With a system, you just kind of sit back and watch and make sure you don't screw it up. That's why you sit back. But okay, if you haven't already, make sure you get our explosive stocks checklist. It'll help you find some stocks that can work really well in this type of sideways environment too. It is more of a trader's market right now, so you could jump in, get the gains, jump out. Checklist down below in the description and comments, or the link to the checklist. Go do whatever it says and get the checklist. That's a good pitch. And if you haven't already, subscribe to the channel, hit the notification bell so you get email notifications of our next videos, because we constantly track this thing. And yeah, I'll see you in the next video. Stay fallible out there. Bye.